Welcome to the Deep Dive. We're here to help you make sense of complex global events and really pull out the key insights you need.
And today, we're tackling something huge, a really big shift in the global economy, all driven by these massive changes in trade policy.
Exactly. And these aren't just abstract policies. They send ripples, big ones, through financial markets, especially currencies, right? Affecting everything from daily prices, maybe your grocery bill, to bigger investment strategies.
Absolutely. So our mission today in this deep dive is to unpack what people are calling the tariff era of 2025. We're going to focus specifically on the U.S. Liberation Day tariffs.
Right, and look at their impact, which seems pretty far-reaching and sometimes unexpected, particularly on the foreign exchange market, the FX market.
Yeah, we'll dig into the reports, the news, and try to pull out the essential facts, maybe some surprising details to get you quickly up to speed on this really critical topic.
Okay, so to really get a handle on this, we need to go back to the start, the announcement itself.
That takes us to April 2nd, 2025. That's when the U.S. president announced these Liberation Day tariffs. He signed an executive order 14257.
And this wasn't just any order, right? It declared a national emergency over the trade deficit.
Exactly, a national emergency. And that let him use the International Emergency Economic Powers Act, the IEPA, to impose these sweeping tariffs.
Which is usually for, major national security threats, not trade deficits.
Precisely. So using it here was a big signal. It showed just how serious, or at least how drastic, the approach was going to be.
And what did these tariffs actually look like on day one?
Well, straight away, starting April 5th, a 10% baseline tariff hit imports from pretty much everywhere, almost all countries.
10% across the board, just like that?
Almost. And then, just a few days later, on April 9th, even higher rates were set to kick in. These were country-specific ones aimed at nations with the biggest trade deficits with the U.S.
The administration called them reciprocal. I remember that term being used. Yeah. But what was the reaction? Did people buy that framing?
Not really, no. There was a lot of skepticism. Analysts quickly pointed out that these tariffs often went way beyond existing foreign trade barriers.
So not exactly tit for tat.
Not at all. And they even hit countries where the U.S. actually ran a trade surplus. So the reciprocal label didn't really hold up under scrutiny.
Politico called it the most significant U.S. protectionist trade actions since the 1930s. Was that hyperbole, or did it feel that monumental at the time?
It felt monumental. That quote really captures the scale. It felt like a sharp turn away from decades of, increasing globalization. Suddenly, every country had to rethink its trade relationships.
Okay, so if they weren't truly reciprocal, how were they calculated? You mentioned a formula.
Yeah, there was a formula. Basically, you took the U.S. trade deficit with a specific country, divided that by the value of U.S. imports from that country, and then cut it in half.
That sounds simple. Maybe too simple.
That was exactly the criticism. Economists jumped on it, calling it overly simplistic, having almost no connection to actual real-world trade barriers. Just flawed reasoning.
I heard some pretty wild comparisons.
Oh, yeah. Some said it was like asking a chatbot to whip up a formula. Someone else said it was almost as random as taxing you on the number of vowels in your name.
Wow. That really paints a picture of how arbitrary it seemed.
It does. It suggests the goal wasn't precise economic tuning, but more like a big, forceful political statement, a bit of a blunt instrument, you could say.
And that bluntness led to some weird outcomes, didn't it? Tariffs on uninhabited islands.
Right. Because of how imports were classified, you ended up with tariffs slapped on places like Heard Island and McDonald Islands, literally uninhabited.
And Norfolk Island.
Norfolk Island, yeah. Population around 2,000 people, facing a 29% tariff. It just highlights how, these broad strokes policies can have absurd side effects.
And wasn't there something else happening around the same time with small packages, particularly from China?
Yes, absolutely. At the same time, another executive order, 14256, got rid of the de minimis exemption for low-value imports from China and Hong Kong.
That's the rule that lets small packages under $800 come in duty-free, right?
Exactly. Yeah. Suddenly, those weren't duty-free anymore. They faced tariffs and had to go through formal customs. This was a huge deal for Chinese e-commerce companies.
Like Shein and Temu.
Precisely. Shein, AliExpress. They rely on shipping tons of small individual packages. This made things way more expensive and complicated logistically. Temu actually stopped selling directly from China to the U.S. because of it.
Okay, so massive tariffs hitting almost everyone, complicated formulas hitting e-commerce. The market reaction must have been intense.
Oh, it was immediate.
And brutal.
The moment that April 2nd announcement hit, global stock markets just plunged.
everywhere.
Pretty much.
Yeah.
Japan's Nikkei and Topix saw huge drops. Europe, too, the FTSE 100, the CAC 40 in France, Germany's DAX all fell sharply.
And in the U.S.?
U.S. stock futures plummeted instantly. Then, on April 3rd, the actual trading day, the S&P 500 had its second biggest point loss ever. The Nasdaq had its largest point loss ever.
Just sheer panic, it sounds like.
You could almost feel it. Imagine the screens flashing red everywhere. Even the Federal Reserve Chair admitted the economic impact was, quote, significantly larger than expected.
That kind of market chaos, especially the scale of it, must have forced some second thoughts back in Washington.
It definitely seems like it did. The reaction was so severe that things changed pretty quickly.
So a walk back.
A partial one, yes. On April 9th, so just a week after the initial announcement, the U.S. announced a 90-day pause on those higher country-specific reciprocal tariffs.
But not for everyone.
Right. China was excluded from the pause, but for most other countries, they reverted back to that initial 10% baseline tariff.
And existing tariffs, like on steel.
Those stayed in place. Steel, aluminum, cars, etc. So it wasn't a full reversal, but it was a significant pause on the newest, highest tariffs.
What was the reason given? Was it explicitly the market crash?
Reports suggested the White House advisors were deeply concerned about the stock market plunge and pushed for the pause.
And how did the markets react to the pause?
They surged. Literally minutes after the announcement, stocks shot up. The S&P 500 had its biggest one-day gain since 2008, a huge relief rally.
But analysts were still cautious.
Yeah, definitely. They warned that even the 10% baseline and the other existing tariffs were still a major burden on the economy. It wasn't like the problem disappeared.
And there was another tweak soon after, wasn't there, for electronics?
Yes, just 2 days later, April 11th, things like smartphones and computers were also exempted from the new tariffs, another sign of trying to soften the blow.
So even after that pause, the situation wasn't stable. The tariff landscape kept shifting.
Exactly. It was like a moving target. That 90-day pause got extended to August 1st.
And then new tariffs were announced anyway.
Correct. New reciprocal tariffs were unveiled for Mexico, set at 30%, and Canada at 35%.
But wouldn't the USMCA, the trade deal with Mexico and Canada, protect most goods?
It would, yes. The exemption still applied to most things, but announcing those rates still created a lot of uncertainty and, frankly, tension.
What about other countries?
Brazil got hit with a massive 50% tariff rate. This was despite Brazil actually having a trade surplus with the U.S. in 2024, which made it seem even more arbitrary. Brazil's president vowed retaliation.
Any deals reached.
Indonesia managed to negotiate its rate down to 19%. So there was some room for negotiation, it seems.
And China. They were sort of the main focus initially.
Right. There was a temporary deal reached with China on May 12th. It lasted 90 days. U.S. tariffs on Chinese goods were cut to 30%. And China cut its tariffs on U.S. goods to 10%.
And that de minimis thing for small packages?
That was adjusted, too. The tariff rate for those low-value Chinese shipments was lowered to 54%. Still high, but lower than it might have been.
Amidst all this policy back and forth and market volatility, wasn't there legal action happening, too?
Yes, that's a crucial piece. Multiple lawsuits were filed challenging the whole basis for these tariffs.
Arguing the president overstepped his authority.
Exactly. Challenging the use of the IEPA for this purpose. And in May 2025, federal courts actually agreed. They ruled the president had overstepped his authority, technically invalidating the Liberation Day tariffs.
So tariffs gone.
Not so fast. Those rulings are currently on hold while the government appeals them. So legally, the whole thing is still up in the air, adding yet another layer of uncertainty.
Okay, it's a really messy, fast-changing picture. Let's pivot to the core of our deep dive. The impact on foreign exchange, on currencies. What's the basic link between tariffs and FX markets?
It's a very direct link. At its heart, you need foreign currency to buy goods from another country. Tariffs mess with the flow of those goods.
So they affect supply and demand for currencies.
Directly. And they can influence interest rates, too. The typical thinking is if a country puts on tariffs, its imports should decrease.
Which means less demand for foreign currency and more demand for the home currency to buy domestic goods instead.
Right. So theoretically, the country's currency should strengthen. We actually saw hints of this with the U.S. dollar during the 2018-19 tariff rounds. It often strengthened when new tariffs were announced.
But it's not always that simple, is it? What about retaliation?
That's the big but. If other countries retaliate with their own tariffs, then the first country's exports suffer. That reduces demand for its currency, offsetting the initial effect.
And if it escalates into a full-blown trade war,
Then you're looking at slower global growth overall. That creates really unpredictable effects, potentially even global recessions. It hits everyone.
are some countries more vulnerable than others when applying tariffs?
Definitely. The limiting factor is often economic growth. Countries that already have high trade deficits and slow growth are particularly vulnerable if they start imposing tariffs that trigger retaliation or slow things down further.
Given all that, how did the U.S. dollar itself actually behave through this? It has that special status as the global reserve currency. Does that insulate it?
It does provide a buffer, yes. That reserve status means there's always a certain underlying demand for dollars, which can prevent really dramatic crashes, even when the U.S. trade balance is taking a hit.
What were analysts predicting for the dollar in 2025 amidst this?
Well, for instance, ING predicted the dollar would actually rally. They pointed to a mix of factors. Looser U.S. fiscal policy, maybe tighter immigration policy, U.S. interest rates staying relatively high compared to elsewhere, and of course protectionism itself.
So not a straightforward weakening.
No. We saw a lot of volatility. The dollar often weakened when tariff fears were highest, worries about damage to the U.S. economy. But then it would strengthen when there were signs of de-escalation, like that pause announcement. It was jumpy.
Okay, let's broaden out. What about other major currencies, the G10 group? How did the euro fare?
The euro was expected to underperform, generally. A key reason is the European Central Bank, the ECB, was expected to cut interest rates more aggressively than the U.S. Fed.
So lower rates make the euro less attractive.
Right. And on top of that, you have the headwinds from U.S. protectionism potentially slowing down Eurozone growth, which relies heavily on exports.
So the euro-USD exchange rate reflected that.
Yeah, forecasts suggested it would trade below 1.05, maybe even move into a 1.000 to 1.05 range for 2025. Plus, you always have geopolitical risks adding pressure in Europe. Scandinavian currencies were also expected to weaken.
What about the Japanese yen? Japan's a huge exporter.
So you'd think tariffs would hit the yen hard by reducing demand for Japanese goods. And that's certainly a factor.
But the yen has another side, doesn't it? The safe haven aspect.
Exactly. When global uncertainty spikes, investors often flee to the yen as a perceived safe asset. So that can push its value up, potentially offsetting some of the negative impact from trade disruptions.
So a mixed picture for the yen.
Kind of. Those yen-funded carry trades borrowing cheap yen to invest elsewhere were expected to become less popular. But the yen might actually perform better than some European currencies, like the Swedish krona, reflecting that safe haven pull.
Okay, now Canada. The Canadian dollar, the CAD. Heavy reliance on the U.S. market for oil, gas, cars, lumber. It sounds really exposed.
Extremely exposed. Tariffs hitting those key exports would directly reduce demand for them, weakening the CAD. It's a classic example of how dependent some economies are on their major trading partners.
And it's not just about trade flows, right? Investor confidence matters too.
Absolutely. If investors get nervous about Canada's economic prospects due to trade friction, you could see capital flowing out, further pressure in the currency. The Bank of Canada would likely have to react.
So if things are challenging for major currencies, it sounds like emerging market currencies, EMFX, must have been facing an even tougher time.
They really were. Probably the toughest environment since 2020, analysts were saying. They got hit by a double whammy. Lower global trade overall and higher U.S. interest rates.
Why do higher U.S. rates hit emerging markets so hard?
Because it makes U.S. investments more attractive, potentially drawing capital away from emerging markets. Plus, many emerging market governments and companies borrow in U.S. dollars, so higher U.S. rates make servicing that debt more expensive, really stress testing their finances.
Let's look at the Chinese yuan, the CNY again. It weakened significantly during the 2018-19 trade disputes. Did we see a repeat?
Yes. There was depreciation again in 2025 as the tariffs hit competitiveness. China did allow some controlled devaluation, letting the currency weaken to sort of cushion the blow for its exporters.
But something was different this time compared to 2018.
A key difference is that coming into 2025, global investors were already heavily underweight China. They held fewer Chinese assets than usual.
So less money to pull out in a panic.
Exactly. It reduced the risk of massive capital flight compared to the earlier period. Also, China's central bank, the PBOC, seems much more focused now on maintaining overall currency stability rather than letting it slide too much.
We mentioned Mexico earlier with those new tariff rates. The peso, the MXN must be incredibly sensitive.
Highly sensitive. So much of Mexico's economy depends on exports to the U.S. Any hint of trade disruption sends ripples through the peso.
And what about countries whose economies are tied to commodities or linked closely to China's fortunes?
Those were definitely feeling the heat. Currencies like the Australian dollar, AUD, the Colombian peso, copy, South African rand, ZAR, the Brazilian real, BRL, they were all affected.
If tariffs slow down China.
Then China demands fewer commodities, which hits the prices and export revenues of those commodity-producing countries. It's a chain reaction.
Were there specific vulnerabilities analysts pointed to? Which emerging markets were most at risk?
They highlighted countries with high debt servicing costs compared to their government revenues, think Egypt, Pakistan, Kenya. Also, countries with low foreign exchange reserves to cushion shocks, like Chile.
Any bright spots or countries faring relatively better?
Well, India and Mexico, despite high debt costs, also have high real interest rates, which offers some protection by attracting capital. Indonesia's rupiah, IDR, was expected to be a relative outperformer in Asia.
Why Indonesia?
Partly because it's less reliant on U.S. exports compared to some neighbors, and also due to some positive local factors. And interestingly, the Turkish lira, TRY, showed a surprising amount of resilience to these global pressures after the U.S. election.
Okay, stepping back from just the currency movements, what are the broader economic impacts we should be aware of from these tariffs? Inflation seems like an obvious one.
Definitely. Tariffs are taxes on imports.
Yeah.
And those costs often get passed down to consumers in the form of higher prices. Inflation.
Which puts central banks in a tricky position.
Exactly. Does the Fed, for example, keep interest rates higher to combat that inflation and support the dollar? Or, if the tariffs slow down economic growth too much, do they cut rates to stimulate the economy?
We saw the Fed cut rates during the previous trade disputes, right?
We did, yes. They explicitly cited the trade war's impact as a reason for cutting rates several times back then. So global uncertainty caused by tariffs heavily influences these decisions.
What about supply chains? We heard about the e-commerce disruption.
It's a huge issue. Tariffs raise the cost of imported components and materials, forcing manufacturers to scramble. They might have to find new suppliers, maybe redesign products, or just absorb the costs.
And that creates volatility for currencies in manufacturing hubs.
Yes, particularly in export-heavy economies like Germany or Japan. And it can also affect jobs, especially in sectors that rely heavily on imports or exports. Productivity might even decline if companies can't access cheaper inputs as easily.
Could there be any sort of long-term positive side to that disruption, forcing companies to diversify?
That's the potential silver lining some might argue for. It could push companies towards building more resilient, perhaps more localized supply chains in the long run. But the short to medium term is definitely painful.
Thinking about investments now, currency risk, it sounds like it became a much bigger deal.
It's always a big deal, but often overlooked. FX markets were surprisingly calm in 2023, but with these tariffs, volatility was expected to spike.
And you mentioned a stat, currency risk is about a third of the risk in a standard portfolio.
Roughly, yes. For a typical 50-50 mix of global bonds and equities, currency fluctuations account for about a third of the overall portfolio volatility. That's significant.
So managing that risk becomes crucial. How do businesses or investors do that? Hedging.
Hedging is the main tool. There are different approaches. Passive hedging means you basically lock in an exchange rate for future transactions using instruments like forward contracts.
Which gives certainty, but maybe costs money.
Exactly. It provides budget certainty, but comes at a cost, and it can tie up liquidity. The alternative is active hedging.
That sounds more dynamic.
It is. You adjust your level of protection based on market movements and forecasts. You might try to benefit from favorable currency swings while still protecting against major losses.
But the cost of hedging itself probably goes up when markets are volatile like this.
Absolutely. Hedging costs are directly linked to market volatility and interest rate differentials, which are both influenced by central bank policies reacting to things like tariffs.
For a business that isn't expert in FX, trying to manage this actively sounds really complex.
It is. Which is why delegating currency risk management to specialist providers is often a sensible approach for many companies. It lets them focus on their actual business.
What should you look for if you go that route?
Key things are experience, naturally. You want a provider who can offer a service tailored to your specific business needs, helps optimize costs, provides clear reporting, has solid technology, and crucially, doesn't have conflicts of interest. And it's really important to reiterate something here, something the source materials constantly stress. Trading in foreign exchange involves a high level of risk. It's not suitable for everyone.
Right, the potential for loss is real.
Very real. You could lose some or even all of your initial investment. So this deep dive, Everything we've discussed is purely for informational purposes. It is absolutely not investment advice.
Always be aware of the risks, and if you have any doubts, seek advice from an independent financial advisor.
Definitely.
So wrapping this up, this tariff era of 2025, kicked off by the Liberation Day tariffs, really underscores how currency markets aren't just about economics 101 anymore.
Not at all. They're incredibly sensitive to political decisions, to global sentiment, to these big geopolitical shifts.
And with those legal challenges still ongoing, the policy landscape's still shifting. It means everyone involved, traders, businesses, investors, policymakers, they have to stay constantly vigilant.
You have to watch for the unexpected, because the fallout isn't always predictable.
It really highlights the deep interconnectedness of trade, policy, and currencies.
Which leads to the final thought, given how complex and far-reaching these impacts have been already, what other unexpected ripple effects might we still see from these unprecedented trade measures? What happens next?
Something for you to keep thinking about. We really encourage you to continue exploring how these shifts are reshaping global finance and just stay curious about this intricate, constantly changing world. Thanks for diving deep with us today.